Imagine you get a regular paycheck, not from your job, but from your investments. Every month, like clockwork, a portion of a company's profits lands in your account. This is the world of dividend investing, a realm where owning a slice of a company doesn't just mean hoping for stock prices to rise, but also enjoying a share of its earnings. In this intricate dance of the stock market, dividends play a crucial role, offering investors a tangible return on their investments. Dividends are more than just a bonus. They are a reflection of a company's financial health and its commitment to rewarding its shareholders. In the grand theater of the stock market, two main characters take the stage in the dividend story: high dividend stocks and dividend growth stocks. Each plays a unique role, offering different benefits and risks to investors. High dividend stocks are like the steady, reliable actors who deliver consistent performances. They appeal to those who need immediate, substantial income. Think retirees or income-focused investors. These stocks typically offer higher than average dividend yields, making them attractive for their ability to provide a significant income stream. However, like any seasoned actor, they come with their complexities. A high dividend yield can sometimes signal financial distress or a payout that might not be sustainable in the long term. On the other side of the stage are the dividend growth stocks. These are the rising stars, the companies that may start with smaller dividends but promise growth and expansion. They are often associated with companies that have strong potential for future growth, reinvesting their profits to fuel this journey. For investors, this means a potentially increasing stream of income over time, a powerful component in the magic of compounding returns. But why choose one over the other? Why not a blend of both? This video delves into the heart of this decision-making process. We'll explore the nuances of high dividend and dividend growth stocks, their roles in a diversified portfolio, and how they can align with different investment goals and strategies. We'll look at real-world examples, dissect their dividend histories, and even run through calculations with a hypothetical $2,000 investment to bring these concepts to life. In the world of dividend investing, understanding the difference between high dividend and dividend growth stocks is akin to having a map in a treasure hunt. It's about knowing where to look, what to expect, and how to balance the quest for immediate returns with the pursuit of long-term growth. If this journey through the world of dividends has enlightened your investment perspective, show your support by hitting the like button. It helps more than you know. High dividend stocks are akin to the sturdy oaks in the forest of the stock market, reliable, robust, and time-tested. These stocks are known for their higher than average dividend yields, making them particularly attractive to those seeking immediate, substantial income. Consider the case of a company like AT&T, a classic example in this category. Known for its generous dividend payouts, AT&T has a dividend yield that often hovers around 7%, a figure that significantly surpasses the average market yield. Benefits. The primary allure of high dividend stocks lies in their ability to provide a hefty and immediate income. This feature is especially appealing to retirees or investors who rely on their investment income for regular expenses. However, the high yield of these stocks can sometimes be a double-edged sword. It could indicate potential financial troubles or a dividend payout that may not be sustainable in the long term. Investors need to be vigilant and discerning. To illustrate the potential income from investing in AT&T, let's consider a scenario where you invest $2,000. With AT&T's the dividend yield at around 7%, the annual dividend income you could expect from this investment would be calculated as follows. $2,000, your investment, multiplied by 7%, the dividend yield, resulting in an annual dividend income of $140. This example demonstrates how a strategic investment in a high dividend stock like AT&T can generate a significant return. This calculation shows how a $2,000 investment in a high dividend stock like AT&T can yield a significant annual income, making it an attractive option for those seeking immediate cash flow. While high dividend stocks focus on providing immediate income, dividend growth stocks chart a different course. They may start with lower yields, but their potential for significant dividend increases over time paints a picture of growing prosperity. Dividend growth stocks are the budding saplings in the investment forest full of potential and growth. These stocks, exemplified by companies like Apple, may start with lower dividend yields. Apple's yield, for instance, is around 0.7%, but they have a history of consistently increasing their dividends. This strategy reflects a reinvestment of profits into the company's growth, which can lead to higher future payouts. Benefits. The main advantage of dividend growth stocks lies in the potential for increasing income over time. This approach is particularly beneficial for long-term growth as it leverages the power of compounding returns. Risks. The risk with these stocks is that the anticipated growth in dividends may not materialize, especially if the company faces unforeseen financial challenges. Let's consider a practical example with Apple, where you invest $2,000. Given Apple's dividend yield of approximately 0.7%, the annual dividend income can be calculated by multiplying the investment amount by the dividend yield. In this case, $2,000 invested at a 0.7% yield results in an annual dividend income of $14. This calculation highlights the initial lower yield characteristic of dividend growth stocks like Apple, with the potential for this yield to increase over time. Over the span from 2015 to 2022, Apple Inc. has consistently increased its dividend payouts, demonstrating a strong commitment to enhancing shareholder value. Starting with an annual dividend per share of approximately $0.52 in 2015, Apple steadily raised this amount to about $0.92 by 2022. This increment reflects a significant growth in the company's dividend payout, with a compound annual growth rate of around 9.6% over these years. This rate of increase is a clear indicator of Apple's robust financial health and its strategy of rewarding its investors with growing dividends. While the initial yield is modest, the potential for growth in dividend payouts can lead to a significant increase in income over time, making it a compelling choice for long-term investors. In comparing high dividend and dividend growth stocks, the choice often boils down to the investor's immediate income needs versus their long-term growth objectives. High dividend stocks can provide substantial income now, but dividend growth stocks offer the promise of increasing income, potentially leading to greater long-term returns. Ultimately, the decision between these two strategies should align with your individual financial goals, risk tolerance, and investment horizon. A balanced approach, incorporating both high dividend and dividend growth stocks, might also be a prudent strategy for a diversified portfolio. In conclusion, understanding the differences between high dividend and dividend growth stocks is key to building a dividend strategy that aligns with your financial objectives. Whether you seek immediate income or long-term growth, dividends can play a pivotal role in your investment journey.